Welcome to the Transparent FX Academy. I'm Nick, and I'm a top author on TradingView with over 190k reputation points. If you're new to the channel, make sure you subscribe. This is the place to go for high-quality, free trading education. Now, without further ado, let's jump straight onto the charts. In this video, I will be speaking about gold. Now, as usual, to keep the video as educational as possible, first I will be covering the technical aspect for this market. Then we will be moving to the order flow by looking at the commitment of traders, so the COT data, which is what the non-commercials, so the biggest speculators in the market are doing, which are essentially hedge funds, so the big players in the market. And by the end of the video, by using the combination of these two different types of analysis, we will try to understand where we have the highest probabilities for the next potential move here on this pair. Now, starting from the monthly time frame, what we can see is that we have the market that is currently testing a quite strong monthly supply and resistance area. In fact, from here, all these previous rejections to the downside were created. At the moment, we can see how the market is testing exactly the same zone. It has already started rejecting it to the downside, and we could expect more potential bearish price action to be developed, as already happened here and here. So on the monthly, we could expect more bearish continuation. Dropping down on the weekly time frame, what do we have? Now, from a weekly standpoint, the first thing that we have to identify is the structure. What we can see is that we have a market which has now broken below a quite significant level of previous weekly support, which is now turned resistance. After breaking it to the downside, the market has already retested it and rejected it to the downside. We can also notice that since we have an impulse and correction, if you want to measure the correction after the impulse, you have to take your Fibonacci from the high to the low of the impulse leg. And if we do that, what we can see is that we had a retracement exactly to the 0.382 Fibonacci retracement, which was in fact aligning with this previous support and resistance, creating a confluence of resistance at this zone, which we could in fact expect this market to test and then to reject to the downside. So here on the weekly as well, everything looks very bearish. Dropping down on the daily time frame, what do we have? Now, from a daily perspective, first of all, I did speak about gold quite a few times in the past. I spoke about it when the market was here. I explained all the reasons for which we could expect this rejection to the upside, and that is exactly what the market gave us. Then we had this correction from here, explained all the reasons for which we could expect this continuation to the upside, and again, the market gave us that. Then after this impulse and correction from here, explained all the reasons for which we could expect a higher high and then a rejection to the downside. And in the very last analysis, I explained why we could expect this impulse correction with retest of this level and continuation to the downside, which is exactly what the market just gave us. And by the way, I will link in description all these previous analysis so you can go and check them out for more free education. Now, at the moment, it's definitely time to identify the new structure that the market has created, also from a daily perspective. But before we dive deep into the technicals from a daily perspective, let's first go and see what we have when it comes to the commitment of traders, so the COT data, which is what the non-commercials, so the big players in the market are doing, which are essentially hedge funds. Now, if we look at the data precisely for gold, what we can see is that with the last reports, we went from having 195k net positions, so a very high net positioning, all the way down to now having only 162k net positions. This shows how a massive amount of longs on gold are getting closed and shorts are getting added from an institutional perspective. In fact, if we look at the positioning of institutions, we can see how we went from having 266k longs all the way down to having only 229k longs. So definitely institutions are in the process of closing their longs, and we can see how shorts got increased from 61.8k to 66.3k. So it is quite clear how institutions are closing longs and adding shorts. Now, this makes gold weaker. And in fact, we can see that already reflecting into the most recent price action with the market trending lower, creating lower lows and lower highs from a daily perspective. And as I was saying, the market in creating this new daily lower lows and lower highs is also creating new daily structure. In fact, we can notice how this level here that has now been broken to the downside is previous daily support, which is now turned resistance. Now, generally speaking, if you have an impulse and the start of a correction and you want to measure the correction, you have to take your Fibonacci from the high to the low of the impulse, as we have done previously on the weekly time frame. And what we can identify is that the 0.32 and 50% retracements are lining up perfectly with this previous daily support, which is now turned resistance, and this creates confluence of resistance at this zone, which we could expect this market to potentially test and then to reject to the downside. So if the market will go for a test of this area, how we could be approaching a potential reversal lower. Now, as usual, trading is reactive and not predictive. The monthly, weekly, and daily time frames combined with the COT data, those are the best time frames from a directional perspective. However, when it comes to confirmations and entries, the best time frames are the intraday time frames, so 4 hour and lower. Therefore, what we could be doing, potentially also with students, is monitoring price action from an intraday perspective during this move to the upside, waiting for the market to shift from an intraday bullish market as we would have to an intraday bearish market. And if the market would shift from an intraday bullish to bearish market and provide to us one of our valid entries, at that point we could be looking for a potential move lower for the market to complete this impulse correction and impulse pattern to the downside. Now, if you don't know what I'm speaking about when I say valid entries and these kind of things, you want to learn more, I really suggest that you go and check out the transparentfxtrading.com website. Here, you have the possibility to get access to my entire courses with all the rules of the strategies. You also have the possibility to get access to one-on-one private mentoring, the VIP market breakdowns with the Telegram signals, the COT data software, which is precisely the one that we used in this analysis, the trading station software, which puts together everything that you need as a trader all in one interface. And if you scroll lower here, past the testimonials, you will see that at the moment there is a massive special promotion in which you have a huge discount on the upfront price of the mentorship program from $497 all the way down to only $97 one-time payment. And as an option, since I have partnered with the forex broker Blueberry Markets, if after you join the mentorship program directly from your student dashboard, you join the Blueberry Markets platform and you move your trading there, you can get a full refund credited back into your trading account. And if you scroll lower here, you will see that there is still some time to join before the offer expires and everything goes back to normal. And from here, there is the button to join in order to gain automatically access with the email and password that you will create during the checkout process. So I really suggest that you go and take advantage of this because there is a limited time left. You find the link also in the description at transparentfxtrading.com, and looking forward to have you in it. If you enjoyed the video, make sure you smash that like button and comment below. It really does support the creation of more free analysis education and updates for all of you, and I will see you in my next breakdown.